Hi everyone, welcome to part 3 of Ross's interview. In this one, which is my personal favorite, we cover technicals. So pocket pivots using moving averages, signs of accumulation, and we also cover stocks like INMD, COUP Software, Shopify, which were the best winners of 2019. So I hope you find this helpful, and if you do, please go ahead and leave a like down below. But other than that, let's get on with it and sit back and enjoy. Okay, Ross, I want to go through kind of some technicals. So I think the best way to do this would be to go through your model book stocks of 2019, and you can walk me through kind of why you've annotated it that way, like why you're buying here and adding here.
Absolutely, absolutely. I mean, what I tried to do here, since we're not, a typical model book like the one that I worked on for Bill, probably had closer to 80 stock, 70, 80 stocks in it. I think we kept this one to 10. So I tried to pick something from not all tech or just a bunch of tech and a biotech. So in this particular case, we tried to spread it out between you can see retail.
You got BLD in here as well.
Yeah, you can see Novacure is, if I'm not mistaken, InMode was one of those laser aesthetic surgery type thing. So I would tell you this, I had the benefit of when we built that model book or created the model book for Bill that I did with Mike and Charles, we did it with Bill. So originally we'd create a list, we'd discuss that list with Bill. The stuff that he is going to toss out is, I don't disagree with it, okay? But the stuff he'll toss out is the riskier biotech stuff that, it could change your life. I mean, it's one thing when, like he made big money in, forget it. Maybe you'll remember the company that invented or created the birth control pill.
I'm not sure. It's not Syntex, is it?
I think that was it. Yes. Yeah. So that's one thing that's changing.
But generally they're riskier because they're biotechs. Right. Yeah.
So a lot of that, however, in 98, 99, 2000, I did very well trading the biotech stocks. So, to me, the only difference would be is my model book, I will make an exception for some of those some of the riskier stuff that has enough going for it, like a group or whatever it is. I don't entirely throw those out. And anyway, for this one, what we tried to do is keep it to the higher quality stuff with earnings and not, and like Bill says, there's so many stocks that you can buy. It's usually getting it down to the best few. Why are you going to buy the garbage with no earnings when you can buy the stuff with earnings? So when you're, during that time when biotech, the big REGN, I used that one in the beginning. What they were doing, not only was their earnings huge, people who were blind from macular degeneration were able to see again after a shot in their eye. Something like that is huge. So why dabble in any other biotech when you've got, a company like that cranking in a ton? You don't need another one. And he's right.
For sure.
He's right.
And how much do you actually take into account the story behind a stock? Because I talked to Leif Serede, who is much more of a swing trader, and he doesn't really look at fundamentals at all. But for you, it seems like it's much more important.
It is, especially when it comes to me trying to hold, and especially now with all the volatility sitting in. So it's much easier for me to sit tight with a company that I know that high quality institutions are more than likely going to follow up. And I had the benefit of, I had 4 fundamental analysts from other funds when I was running the fund in New York. And those guys wait for the market. They don't care about the charts. They're building models and spreadsheets. The price in their mind is based on earnings, sales, their phone calls, conversations they have with industry experts, that sort of thing. So to them, if they think a stock is fairly valued and it gaps down 10%, they're like, woohoo! They're, where we're like, ooh, to stay away. They're excited by that. So and then they will scoop that up. So that's my thing there. And what are the best institutions? They're buying the best companies that make the most money with the biggest earnings. So I have a much easier time sitting, feeling like I'll be saved on something like that relative to a blank check company that might have, 13 small institutions that you've never heard of with some small positions. And I just, very easy for me to get shaken out of stuff like that. So For
when you
me,
have that conviction, it helps you stay with those stocks.
it helps a whole lot. And especially, during those times where if I'm going to have 2 or 3 positions in my account, that are taking up most of the space, I've got to know that listen, I've sat with Bill long enough to know I watched him do everything that he made the giant money on is one of those super high quality, institutional quality, big earning, super liquid stocks. And those are the ones that are going to get, that are going to get saved early on
Gotcha.
when the market leaves.
So let's talk about Shopify then, because this is the model book from 2019, but this could definitely be it on again this year.
Correct.
It seems like. So before
that. So
for sure. So let's talk through this chart, and if I click it, I think we can get a maybe zoomed in view. There we go. So let's talk through the chart and what you're looking at in terms of both price and volume, and how you would manage this position if you owned it in the first place.
So, these are my favorite ones. You get the breakout, it just stair steps its whole way up. It consolidates, it respects its 23-day, not perfectly the whole way up, but for the most. So let's start from the beginning. You've got the buy here breakout, and sure enough, in this market's frustrating fashion, you get a nice shakeout and retest that ultimately works anyway. Again, so you've got to shake out below the 21 and 23-day moving average. Now, mind you, my goal is to always, or it's not my goal, my rule is my stops are on a closing basis. There are times where, another rule will say, forget, it's just time to get out for another reason, whether I've got a line in the sand on just the amount of money I'm willing to give up for the day off of highs or whatever it is. I've got all kinds of stuff but anyway, there's no reason to sell. You've got a retest of the breakout. You shake below your averages, and then again, you trade nice and tight. It works. And it's amazing how, again, you trend higher, you pull back, test the averages. You've got nice tight closes again. And so my goal, and now this is a goal, not a rule. My goal will be to get in on that first breakout, and a lot of times you see how I have the line here, depending on volume, I will often sneak in early here, maybe even a little. And always with the, like I tell you, when I'm starting, I'll always keep a super tight logical stop so that if I'm wrong, I can buy it back again. So keeping in mind on a closing basis, I hate sitting through these, but I've learned to sit through them. What's even harder, and I'll throw this at you, Bill, for the most part, used to trade off weekly charts. So he would let unless you see a big, he had the rules that would otherwise get him out sooner. But for the most part, he'd wait till the end of the week to make a decision, that weekly close. So for me, sometimes it's almost feels like impossible to wait till the end of the day, but I always try to remind myself, Bill gives you till the end of the week. And in a bull market, you've got to do it. How many times have you seen where it's just, the last 10, 15, 20 minutes of the day has just made a huge difference as everything bounces. So
sure.
It's very easy to get shaken out in this market. There's no doubt, unless you have got a plan to operate within all of that volatility. So it can be done. It's just got to be done, carefully and very, you've got to have it planned out ahead of time. Be exact with it. But anyway, a lot of the time, the set and forget. So Shop is one. It's a big liquid name. It's got the huge earnings. So here's one I'm going to feel a little better about leaving alone. So if I don't see this thing close below its 23-day moving average, once I get started here, I'm in great shape. So anyway, we finally so one day that we close, that we break down and close below, is not the end of the world. We closed a hair under support right here, this line. We've also got your 50-day moving average below, not to mention it's, so you're still in pretty good shape, even from your most recent buy point. So you're not being forced out here. Let's say you want it, and there's nothing wrong with selling a third and then trying to buy it back again. And there's so many ways that like I'll tell, there's no right and wrong way. There's only what's right for you, as long as you're managing risk along the way, as long as it's, within the frame of a methodology that's working and you're managing your risk. So you're still in great shape there if you haven't, I mean, even you could have bought anywhere in the base and that. So you've got enough support there, and you can see within just a couple of days, you know, it never really breaks below that low, and you reclaim its 23-day, 21 and 23. Now, I don't know if I went through there, and these, I'm going to back up 2 seconds.
Yeah.
We've got a 50-day is the black line, 65 EMA. So you've got a simple. What I will find, and not in this case, in many cases, a stock will break its 50-day moving average and be picked up by its 65-day. The same I find of the 21 and the 23. In this case, they're running pretty close together. You can see here, you get a break of a 21 and support at its 23. That
Gotcha.
often with its 50 days. So that people, anyway, I've done enough work and studies on that to know that the 23 EMA and 65 EMA, I think I mentioned it before, are significant. So with all of that support there, you're in good. And so back to what I was saying, my goal will be to get on a position. And if I can get the 50-day moving average to be my trailing sell stop, that's my goal. So 50-day. Now, if I got a stock that, you know, like we just saw the market run up like crazy and the 21-day moving averages got super far extended above the 50 days, I'll sell half that position. So you'll see when stuff starts getting extended, my 50-day moving average trailing stop will turn into half at the 23, half at the 50.
Gotcha. And so you held this all the way until it broke that definitively the 50 and 65 EMA all the way up in September. Gotcha.
Yep. So this one, you know, and this one doesn't. This isn't really one. I'll show you. It's not even one that where back in history you can see it gets saved by its 65. But in this case, you know, all the averages rolled over, and yes, it was the first time we were breaking through both. So for me, that I've got no problem eliminating anything that I didn't possibly sell, you know, and I might have sold some here on that big break, who knows, but anywhere between here and here, I've got no problem eliminating and buying back, you know, revisiting a stock. And it's fun. And that's another thing I'll tell you, sitting with Mike and Charles, building that model book, you know, when you go through these big ones, that's when you go, you know, a lot of stuff clicks in your brain when you go, oh, so it's these big liquid high priced ones. And okay, so I'm looking for the big liquid high priced, high relative strength with the huge earnings that break out and tend to show an incredible respect for major moving averages. There's enough of them that, you know, if you can catch them and get that, that's kind of my thing. I tried. So if I can get the 50-day under me as a trailing stop, and if things get really super extended, I'll use the 21, 23, you know, for a partial stop, because a lot of times once they get spread apart like that, if you get a break of the 21 off in the 50 days next, unless there's, you know, another area of support, that might hold it up.
Kind of what we're seeing right now with the leaders. A lot of them sliced through their 21 EMAs already, and it looks like they might meet up with their 50 days.
Right. So if you got the 50s and then you got the stocks, especially the ones I know off the top of my head, Dexcom, that one recently, as it's been as it breaks its 50, it holds its 65. It's held by its 65. So if Dexcom broke at 65, I'm done.
Gotcha. And I've seen on your charts that you mentioned pocket pivots. Can you kind of explain what those are and also how you use them in your day-to-day trading?
So, you know, what pocket pivots, you know, and that those are created by Chris Catcher. I'll tell you what, I was actually on the phone. I used to talk to him when I was sitting in New York. I would chit chat with him when he was in London. You know, he'd be up at 3 o'clock in the morning working on that, and I'd be at with the time difference. So that guy doesn't mess around. I'll tell you what, if he did the work. So anyway, so what a pocket pivot does is for me anyway, is it's just another solid clue as to a very often subtle accumulation in a base. So it gives you a way to buy a stock before a breakout in some cases, and also when a stock, let's say, picks up volume but doesn't necessarily trade forget above. In general, you want to buy a stock 20%, depending on what it is. If I want to own it, if everything else is going for it, maybe I'd let it slide 17-20% on a bigger cap name. But oftentimes, and you'll see a lot of a lot of times stocks will break out on less than average volume and they simply don't work. However, I will say I've seen plenty lately that break out on less than average volume and then leave me in the dust.
Yeah.
So this helps with that, because you can get a pocket pivot where as long as you're, and I'm, for the benefit of our, the people that don't know, basically, I didn't label any here, and I'm sure there's fistfuls of them.
Here, ARWR's got some here. So let's open this one here. So right now you're explaining what a pocket pivot is, and it's a sign of accumulation, right?
Right. So it's a sign of, sign of accumulation, oftentimes subtle. In these cases, you're seeing, so the first two here, I write pocket pivot volume signature, because often this is a breakout. You're not really getting, it's pocket pivot volume on the breakout. Typically, the idea of catching a stock at a pocket pivot is something prior to the breakout. So they'll, Chris will refer to that as pocket pivot volume signature.
So this one here is before the true break or the second breakout here, but you're looking at both the price relative to moving averages and the volume here. So could you explain what a pocket pivot is? Like, what's the definition of a pocket pivot?
All right. So for these to be a pocket pivot, this volume, now granted, these are at average, which typically wouldn't be enough. This one's only a little, I'm going to say just by eyeing it, these aren't enough above average. However, what makes them a pocket pivot is they've traded more volume than all of the volume or all of the down volume in the 10 days prior. So if you count 1, 2, 3, 4, 5, 6, 7, 8, 9, I think we're ending 10 here. You can see that the highest down volume is this day right here, which is less than here. And that, you can tell just by eye, the same is going to go for the next 2 days, right? As long as this, so that those wound up being pocket pivot volume signatures. Not so much pocket pivots. They don't have that. They don't have that. I would tell you what, I would buy this. See, and you can see buy here. I will buy that pocket pivot. I will also. So the other thing I was going to look for or that I was going to talk about that I don't have labeled here are 5-day pocket pivots, and you'll probably see some of those labeled, which is the same thing. And it just has to be bigger than the prior 5 days down volume. So when I see 1 day, I will give a stock a break. I'm not going to put on a huge position or buy a lot with the 5-day pocket pivot. However, I have found that multiple 5-day pocket pivots, 2 and 3 of them, little clusters of them are rather effective. So
these are early entries that help you build out that position before that true breakout. So you've already got your core position below, you've got your cost basis low enough that you can just add on to the breakout, and you can kind of sit through that pullback that you can actually see right here, and then actually forms a whole nother base at this point. But it pulls back after the breakout here, and then it starts moving up. So if you got your costs down here, it's easier to stay with that position.
Right. And I mean, you can see it's one of those. These are one of those things where it's just, you can buy it, it never knocks you out, and it just takes forever before it works. And I'm not, sometimes I get to, if there's a ton of other stocks working and I'll see this breaking down. Sometimes if I start seeing it to break a 21 day and there's other stuff working and you can see it's respected, it's 21 and 23, I'll toss this thing and buy it back as it builds a new base. And, even looking at it, I didn't draw the line, but if you could even draw, sometimes when I see a little consolidation like this, if I'll draw a line and if it blasts through, or gives me a pocket pivot, I might stake on a little position. And what are my stops? The stops, you see that purple line that it's respecting there? I know what that is off the top of my head. I don't have it on my charts anymore. It's a super short term. It's a 4-day exponential moving average. So if I were to sneak in on something like that, so that's when I tell you it's either going to work or not work. If it closes back below that purple line, I'm done. Yeah. And then I'll try it again, and it always that way, this is another thing. This was a lesson that was passed to me from, again, Chris Katcher, who actually had he was lucky enough to be able to sit with Ed Sekoda, who is, are you familiar with him? Crazy.
I've heard about him too. Yeah.
Commodities trader. And I think he showed Chris one of his most successful trades. He actually got stopped out 6 or 7 times first. But what allowed him to, to keep his head out of his butt and stay positive and buy it back that seventh or, sixth or seventh time and finally knock it out of the ballpark was that, he kept his losses super, he kept doing it super tight. So, and even in this case, if you start doing it, a lot of times you can get yourself out of the way for even a small profit or, so that way it's super easy to, and if you start using one of these, that's just to get yourself started. So that way you're, if you've got a stock and you expect big things from it and it gets a false start, that way you can at least, kind of ebb and flow with it a little bit. It gives you a way to not have to, it gives you a way to manage your risk along the way. And fortunately, something like this, most of the time, these stocks are going to be fairly liquid. So if I have to put on a final chunk at the market, it's not the end of the world.
For sure. And just walking through this year on ARWR, you've got this nice first base here. You've got this early entry that you've identified before the biggest resistance level here. So you've started this buy, it works right away, forms a base on base, then it works again on huge volume. So then after you build up that cushion, are you taking a little bit off and trying to ride it for the rest of the move? Or are you really just sitting in this with size?
This one, because you've got the base on base, but no, once I start to get up, so where's it going to be? Once I'm up 20%, and typically even out of the first breakout to where I will start, and I'm going to say this one, I'm probably isn't going to be that one that I'm going to oversize in a huge way. It's not going to be a ZM or a Tesla, but I'll tend to oversize them at that what I consider the low, you got this big outside day, you've got all that, and I probably should have started. See how all the averages bunched up and now they're expanding? I've noticed that average will tighten up and they converge to the upside in a tight bunch just below price, and that often should. And what I'll also notice is when the market's in correction and you're watching stocks, that you'll notice an entire group start to appear to be under accumulation, and you'll see those averages starting to, tighten up. So that is, but anyway, so that's enough. So for those reasons, I might put on a big chunk here. Now, Richard, if it ran from there up 20% to here, I'm pointing with my fingers to the top of this space. If that was 20%, I might take off for a half or a third of it and only add that back when it breaks out again. And then, and often it's just my style. I'll add back more than I sold.
Gotcha. So what's the next one? We've got BEP. So actually, I didn't trade this one. I wasn't watching this one. So this will be cool to look at.
Yeah, absolutely. And then normally we wouldn't do, I wouldn't do a utilities, but I think there were, at one point they were rocking and rolling. This one had the huge earnings and sales, and I just took a shot at it, and it just turned out to be one of these that smoothly, I can, sometimes Richard will take a shot at something that just has the earnings and enough going for it. And sometimes it's just luck. They break out and they go and they just perfectly kiss their major moving averages the whole way, never scare you, never give you a reason to sell. I had the only stock I've worked out to this day is Charles Schwab in 99 when it was SCA, when it was 4 letters trading on the NASDAQ. I bought that breakout and I didn't sell, high of the day, but I sold top day. I was jumping up and down cheering in front of CNBC. I'm not joking. I caught myself and I went and I looked at the chart and I'm like, yeah, there's your climax. And I called, I was on the road. It was I think I was still, I don't know if I was on vacation or on an institutional sales trip, and I, called the O'Neill desk and sold it all at the market. I think, if I remember, maybe $7 off the absolute high top day. But that's the only time. That's the only time I've ever done that. So anyway, and that's one of those ones that I bought, and it just made it really. There was no magic to it. I'm not so great. I followed Bill's rules, and that's one of those ones that just broke out for me, and I happened to catch myself at, right as it was, doing its little climax dance. So anyway, BEP, I go through all this utilities. You're rarely going to see this in a model book or even in my newsletter, but it worked out so well. We just, we included it here, and you can see it. And if you go through, I'll point out, you'll notice, look at all of these stocks. For the most part, these are all your smooth stair step. They respect their moving average. There's plenty out there. I'll give you a perfect one. What is it? NOW. That thing stair steps straight up. But that is so hard to trade. Buy strength in that. You buy strength in NOW, good luck hanging on. It's, you know, it's one of those stocks. So it's a huge leader. Their earnings were there. That is not my style. There are guys though that are so good at scooping off of, you know, those support. And if you're good at that, it's great, because another stock that's really hard to trade on strength, it doesn't have the earnings, but it's, you know, one of the hot IPOs, NET, another one off the top, another tough one. It'll break out. If you don't sell into strength, if you buy that breakout, you're going to suffer before, you know, if you buy a breakout, then chances are you're going to suffer before you're going to give it all back. And my guess is ultimately be fine, but it's going to be painful along the way. So here, back to, so BEP, they're, again, nothing. It had the huge earnings and sales. It's not the best group in the world, but again, you know, you've got the, here, let's go make it big again. Sorry, you can't see it. So it just happened to be one of those things that I threw an alert on because I saw, you know, early alerts. Actually, there's no real, I can't remember why, what other than the earnings, the liquidity and the chart looked that good, and it just happened to work for us. So I think Bill would say it doesn't belong in the model book just because it's a utility as I look at it now. But, you know, other than that, it was one of these things that just had the really smooth stair-step pattern that respected its major moving averages and made it easy to buy and hold along the way. I think it's pretty, you know, pretty self-explanatory. You've got the big volume here as it's breaking. So you've got your nice big volume trend here, of course, right? And so
off the bottom, yeah.
Right, off the bottom. So you've got a nice big volume here, and you're starting to tighten up. Now, my guess is there was enough in the group going on, and this one had the earnings. So for whatever reason, you start buying, you know, if you decide this is you want to buy this utility for whatever reason, this is where these are some early entries here. There's nothing proper about this. It's cup and handle-esque. However, there's not, you can see there, and this is one thing I will tell you, and I'm not going to say I disagree. I think if you look at the power that be might tell you that you want to be able to name a base. You've got to say, this is a cup and handle and it's proper because, or this is a double bottom and it's proper because. I'm going to tell you a lot of times the cup and handle-esque and the double bottom-esque works as long as, I'm going to say, so it's more important that you can spot accumulation versus distribution along the way. So if you've got the group working for you and the earnings working for you, and you think you see distribution coming in, but it's a stock that might be 30% off its highs as opposed to no more than 15% as you would typically do. Because why? Because you don't want that much overhead resistance. But however, when you've got accumulation coming into a group or whatever it is, I have found you can, now I have my rules for sneaking in early. Like I tell you, you just keep a really tight stop loss. And if you're wrong, you're wrong. And that's what allows you to kind of build your way in along the way, starting early. So by the time, let's say you get to a more proper entry area, you're pyramiding a final position, or, you know, putting on an extra buy instead of, so this was this actually wound up just being a really boring, relatively boring. I'm looking at it. I'm not sure why I picked, let's see, 67% gain. I think I picked it just because it was so tight. It traded so tight in such a tight and organized manner. I put it in here and it took a bit of a long time, I would say. So 67% from February till the end of the year. It's not terrible, but it's definitely on the lighter side. I'd say we move on from this one. But I think the reason that it's here is you can see I'm pointing again with my fingers. It's got the nice tight bases when it breaks out, so here you get this shake, you've got the re-breakout. It did, right? So it tries to break out, it comes all the way back in, it re-breaks out. 9 times out of 10, I would never buy this if I didn't own it already. However, if you bought it here or earlier, you can see it perfect. Yeah, every time it broke below its 50, it got saved by its 65, which it did, stopped you out, and it just kind of worked up. And I don't know where the stock is today, but it was just, so we included it because it just because of the way it built nice tight bases and moved up in an organized manner. It gave you an easy 67%. And, you know,
for sure, can't complain about that. So
no, yeah,
let's move on to the next one. But I mean, it's good to have some of those in the portfolio to balance out those IPOs that are a lot more volatile. So it's good to have that.
absolutely. Listen, I'll tell you the mistake I made in the beginning. I eventually got on the bandwagon was in, I guess it was 06, 07, 08, when all of the stuff, you know, when China was undergoing, I guess, its industrial revolution, you could say, and the potashes, you know, the agriculture stocks and the building stocks and the steel stocks and oil stocks, typically, I stay away from all of that stuff. Eventually I got on, you know, so I think sometimes I will see the REITs, a whole bunch of stocks working with huge earnings, or some utilities that appear to have huge growth, and we'll include them in the mix. So anyway, that's how that happened. CDLX is our next one. I think this one was still relevant up until, right? This one's still a relatively new stock, if I'm not mistaken. I don't have.
Yeah, I'll look at the chart right now, actually.
Here, I'm gonna look with you.
Yeah, it's basing a little bit. Doesn't look too
Right.
bad.
So okay, so that's it. You can see I had an alert on it, and then here it broke down to it. So worth keeping an eye on. It had the earnings. It's losing the earnings. It doesn't have the estimates. And let's just take a quick look while we're at it. Yeah, there's nothing special going on here, but up here, I guess, is where we were looking at it. In that case, and you can see we had the triple-digit growth down here in the sales. So it's nothing special today. It's working on a base. So here we go. Another one. This is this first buy here. Again, that's
great volume coming in.
Right. So that's one of those things where it's just breaking above a major area, you know, of resistance, a prior high. The volume is enormous. So risk reward's worth it. And remember, at this point, enterprise software stock was hot. This was one of the hot ones. And so you got the group and everything working for it. So here's your first early entry. And then again, you'll notice that it got picked up. Throughout the length of its run, and these are the ones that I'm always trying to build the biggest positions in, with the big numbers and the ones that are liquid, that respect their moving averages. It makes it so easy I'm not going to say so, it makes it much easier on the heart. It makes it much easier to sit with, and it makes it much easier. Ray is very good, who I work with at TraderLion. He's great at, buying things in the hole, so to speak. So when I see these stocks tight, so I look at the stock and I just see right here, I wrote at every break of its 50 contained by the 65, but it's so nice and tight and organized that it's the DXCM. I don't know how that closed today. I wound up walking away from it way before the close, just because I didn't want to.
Yeah, it was kind of ugly as well.
No, you got me curious. So I sold that one anyway ahead of time, just because I was printing all-time highs. And so this is another rule, and I'll just explain it to you. So I don't care what happens. At some point, I don't care. I'm at highs. I've made a good amount of money fast, and I'm not willing to give. I'm only willing to give so much back. At some point, I don't care what stocks I have to buy back, because 1 or 2 days of being extremely heavy for too long will destroy your year in a hurry. So
for sure.
So it was just again. So every time CDLX, moved sideways, respected its average, built the base, and poked its head back out above that consolidation on volume. It very simple. Every time it poked its head. Here you go. Here's another. Did we discuss the Darvis book, Nicholas Darvis? Okay, so that's a Bill O'Neill required reading. So this is building little boxes pretty much, not perfectly along the way, but this is one of those ones where you could have bought support on the moving averages, or, bought it as it just poked its head above your Darvis box, and more or less been fine along the way. And I marked and so you can see this shakeout below the 50. You can see never even touches at 65. And then here I will point, you see this right here, I will buy, but I will typically buy, I won't overbuy this. I like it because you're base on base, and I love the volume and that sort of thing. The part that I don't like here is you got you went straight up from the 50-day to a breakout in 3 days. Nine times out of 10, that's at least going to come back in and retest, which it did. So I will buy some. It doesn't always have to. I hate the straight up off the bottom. That's a big no. I don't break. That's a Bill O'Neill rule. Buying breakouts when you get a straight up off the bottom breakout from the bottom of a base or a 50-day moving average without any sort of consolidation, it's more failure prone. We'll just leave it at that.
Cool.
But anyway, and you'll see it came back and tested a few times, and we didn't do it. But here's another, just while we're looking at it, this was viable right here. You're on top of a prior high. You've got your moving averages right there. If you buy it, your 21 and 23-day moving average, you've got the confluence of that prior high there. I mean, I love doing that because you can't get better risk reward. You buy it there, and if it breaks, forget on a closing basis, you just get out of the way. And if you're wrong and it recovers, you can buy it back again, and a lot of, for minimal damage. So that's what we're looking at here. I think we just took a look at it. I think CDLX did it. What's the date here? I think it kept going for a little bit longer. We don't need to. And here, I just want to take a cruise through and see which ones we've got here.
Yeah, COUP was also enterprise software, so that was hot early in the year.
Right, and that one again today. Let's just go to it. I think I had that as an add on I mean, from here, I think we caught this ad, and then, so we're still, even if you bought this ad, you're still good at the 50-day. And what I love is you've got the conflict, well, I digress, but it's still relevant. You've got the conflict of, so you've got your Jesse Livermore figure, your not the 100 mark, but the big round 300, which is, you can count the same as the 100. So you've got your 50-day there. That's another one. I think that had I caught that today instead of, I walked away from today was one of those days I walked away. Sometimes I find it better to just keep my hands out of the cookie jar and coming back to things the next day. But that's to me a very sweet spot in terms of risk reward right there. This right here is COUP-ish, COUP-S, right? So if I can see accumulation, tight area, light volume, all of a sudden huge volume pickup, very constructive price action. We close through what I would consider relevant. You can put on a position there, and your risk reward is super tight. Pick an area of support below whatever makes sense, right? So that way, if it rolls over, you're just out with minimal losses and you leave it alone. I haven't done, and I'll be honest with you, I haven't done an official study or anything like that, but I figured this out this went into observational test mode when I was running the fund in New York, because there were stocks that I like to buy that you simply couldn't buy 200,000 shares of at the market on a breakout. So so this is what I did. I said, okay, as long as I have enough edge, I've got the moving averages bunching up, a nice tight area. We've got big volume pushing off of that, and if I'm wrong, I'm going to cut myself out, whatever it is, I'm going to draw a line that looks like, and so if I want to buy it back, I'm not going to be sad about it. So anyway, you start here and you can see it continues to work on huge volume. And it's riding up its short-term 4 EMA, basically building the right side of its base. And this is really kind of wedging up along the lows. I mean, maybe you could say this is a mini 2-day handle there. Maybe that's your drift down. So now let me get back to counting cards. If I remember correctly, at this point, we had all of the enterprise software setting up. The market was, super powerful at this point. So to me, this is a hot deck. The group is working. It's high relative strength. It's you've got everything working for this one. Not to mention, technically, you've got so much going for it. So this is one. There is no proper pattern here, but that's why I'm sneaking in early. So by the time, and now remember, there used to be only COUP with handle. Now there's just COUP breakouts. Now, and which I love, because they changed with the times. And I figured, I'm not going to say I figured this out a long time ago, but I noticed there were a lot of exceptions to the rules, Richard. I'd see a stock that had a wedging handle or something that I would consider a flaw, and I would ignore the stock and it would work anyway. So if I have a stock like this that has everything working for it, and I'm working my way in early, and it might, to me, this little area here kind of fixes this wedge. I kind of like that little, but even if it is wedging and it breaks out, I may not put on a huge position. And you can see you do eventually get a shake. And I'm not going to say that it was because you didn't have a proper handle here and it wedged into the breakout. Bill might tell you that that was an imperfection here, and that's why you had this shakeout and it didn't work immediately. It's also why I like to start buying early. But in any event, this ultimately works if you're able to sit through that, which you could have. You never go negative on it, not to mention it holds its 50 and 65-day moving average. However, if I looked at this and I saw this, I'm getting much better at sitting calmly through that, but it's hard. I mean, to watch it, to get that far ahead. But what I've learned also is to not start early and put on a full position here, assuming it's a liquid stock, and then get all the way out to here. And have it is so much harder on your brain and your heart, especially when you get out to here. So if you've, finalized a position here, or maybe even you bought more than your full position, so who cares if you get shaken, then at least you can get shaken out a little bit, right? And I'm sorry if I'm leaning out of the picture. So that, to me, the whole early buy thing does a lot more than allowing you to put on a larger position of a thinner stock. It allows you to maybe cheat your way in where you might not see perfection, and you still can
sit through that base a little bit. Yeah.
Sit through all of it. Yeah.
Yeah. Yeah. And so I was just saying that this reminds me a lot of LVGO. So could you go to Market Smith real quick and go back to that time period? Because this is one of the big winners of this year, and it's got that same mini little cup before the true base breakout. So they've got a flat base driven here, but there's that 3019 pivot. That's kind of the top of that cup that we were just talking about.
And even here, I would look at that, right? So you're exactly right. If I saw, so as it's coming up the right side here, I'm eyeing that 3019. But now you put in a little handle, couldn't have been more perfect, right? Volume dropped off to below average. And so I would even use whatever the high is there and cheat a little bit more, Richard. 29.21, it's not higher here, is it? Nope. So 29.21 would become my price, and I would do 29.21, 30.19, and then 31.82. So 31.82 is your textbook spot. And in this case, there's nothing wrong with it. It gives you, hardly trouble the next day. That's not the end of the world to have it pull back on lighter volume. But I mean, you just had to be patient for 2 days, and it never looked back.
And this is a monster stock.
Oh, I mean, this thing is a total monster. I screwed this one up along with a couple others. But this is a model book monster of epic proportions. I mean, you could have, like you said, you could have been in early $29, $30. It ran to $150 in how long? So roughly from April to
just a few months. Yeah.
That's not a bad return.
Yeah. All right, cool. So let's move on to the next small book stock from 2019. And it's so important to look back on the leaders because you see the same thing over again. And like you were talking about with the one that maybe wasn't a growth stock, BEP, it still has that character of nice, steady performance. And what speaks to me is all of these clearly under accumulation. You've got huge up volume, and then they obey those moving averages.
Absolutely. I mean, there's no reason to make it super difficult, but Rich, listen, I'll be the first one to tell you I love buying those crazy biotech stocks as well. I do it. But in general, when I'm putting on the super big positions, it's not in a beat. It's going to be Shop, Tesla, ZF. I don't have to tell you, there's probably 10 that we can all name off, at the top of our list with the giant earnings that are in the leading groups. Those I've learned. That's of course one of the the big lesson. Bill puts all his money in one or two stocks and sits there for years. To be able to do that, but those are always, the Qualcomm, at the times that he's doing it, Qualcomm, AOL, they're always that giant, big, liquid, institutional quality name. And I'm going to tell you 9 times out of 10, they're going to be one of those organized, liquid patterns that tends to respect the moving averages.
So let's talk about INMD. Yeah, this is a good one.
Right? This is the aesthetic, right? I think this is the one. I want to say this is the one I looked to go see what it was, and I'm like, aha, this is how all the stars are making their faces look young, right? I think they had Kardashian and all of
Yeah.
those people on the website. So that's, and I'm like, that stuff sells. I mean, if you can look 26 instead of 40, women like that stuff. So that, you know, this, to me, that had enough. When I saw Kim Kardashian on there and I knew what it was, and I lived in LA for a while, and I know that's a hot thing. The people like it. So here
Solid
we go.
fundamental research right there. I like it.
Yeah. You know, I always tell myself this. I did so well on TravelZoo. I mean, I know it's a travel site. I've never used it. I think it still exists. But after doing so well on TravelZoo, that's, you know, sometimes when it has the earnings and I go, okay, this is how all the girls are looking young. That's a big thing, you know, that's a big thing these days. So this seemed to be the one. And I got to say, those Kardashian kids, they've got smooth skin. So it works, right? No.
So
anyway, so this is also, it's one of those, I love IPOs, the IPO U-turn or any of the IPO bases. Just that IPO U-turn or the IPO base, I call it the U-turn, whether it's an actual U or not. Just anything that starts over here and eventually works its way back out the top side is that IPO base. I wind up calling them the U. So you don't even really have, you've got this sideways action, you gap through the top. You know, I don't even know that you were anywhere close. That would have been very tough. You know, especially if it gapped there and it was one of those things that gapped and went, you're very highly likely, I'm not buying that. That's not my style. However, you get lucky enough to, you get what looks like it's turning into a nice pennant or bull flag. You've got your little, unfortunately, you get the shakeout here. Now, this is the kind of thing, Richard, also where I might see accumulation, a nice tight flag, and I might start nibbling a stock in anticipation of this flag working, and I get shaken out right here. However, I wouldn't hesitate to draw the line back across. You see, I can't draw a line, but
yeah,
you know, sort of that declining tops line and buy it back again. And let's just move down here. You can see this one had the earnings and sales going forward.
Yeah.
Exploding along with all the pretty smooth skin. So not to mention if I'm the medical equipment group was solid. I'm a big fan. So when a group is running, if you got a 90 plus relative strength stock, that's that is not what we wanted. I was trying to.
You want to open the image? Yeah.
Right.
This one, I have a fundamental rank sheet where I use all the data and sort by all the can slip characteristics. And this was number one for months, even as it was increasing like this.
Gotcha. So yeah, this was just one of those ones. It was beautiful. You said you could have bought it here. The reason and you'd have been shaken out right here. You would have, been out for even, maybe you would have made who knows. So that's why we start. So this was absolutely viable. The reason I didn't include it was I don't think we actually caught that in this. So anyway, it's not worth discussing because you see it shakes you out, you build a whole new base. And so, and this one, I don't know that this is even a proper base because I don't think I don't know if we're 5 weeks here, but in any event, it doesn't have the look of a proper cup or a proper cup and handle. However, you've got this powerful IPO. It's got the earnings and it's making the girls look pretty and all the stars are going there. So you've got the breakout, the volume is huge. And then it's another one of these things where just following it, it tends to, I don't know where this thing is now or where it went from here. We're going to have to take a look, but it's another one of those powerful IPOs in the right group that just, I love these. So to me, even if I don't get it, if it's liquid enough, as much as I can buy without, this is one of those stocks, if I can, as much as I can possibly buy without moving the stock on my own, I will. And, here you've got all the retests. It's very frustrating, but I'm everything's on a closing basis for me. So this is a proper breakout for me. If this doesn't drop the 7 or 8%, like the rules say on it, I'm not selling this stock. So again, you can buy the breakout. It consolidates right above its prior high and breakout. And then again, it gives you a little add-on point. I write by here. That's really more of an add-on entry. And again, this is one of those things where if I've already got a nice, position on, and it's if I remember correctly, I'd have to go back and look, Richard. I think I bought and actually added on these pullbacks here personally. And so by the time here, if anything, I put it on small. And again, what's my sell stop on that? Maybe the 10-day. I don't want to be wrong and mess up my position after, doing all the work down here. And then it just, as I write, it just explodes again. You can add on again. It's again, now you're getting risky, because to me, I'm probably adding here after putting on a chunk. So you've got, I always keep in mind, you want to be using it's got to be, I always try and keep my sell stops tight but logical. If I'm using a tight sell stop in the middle of nowhere, I try not to let that happen. It's got to be tight and logical, at least at a moving average or prior high, somewhere that makes sense. If it's sticking up straight in the air and I'm buying something and there's, are you with me? I can't buy just to buy and hope it works. There's got to be somewhat of a reasonable stop nearby, or I'm not going to do it. So
for sure.
So that, at this point, you're getting up a little, up and out of the way, and you're talking about a stock that has already gone from 13 to, you're almost tripled at this point. So I start to get a little more conservative if I'm going to be adding stuff, and I'm quick on the trigger with the trigger finger. So, you'll see, even if you buy it here, it runs up 20% in a hurry, if I'm not mistaken, right? So roughly $42 to, right, 40 to 50 would be 20%. So on a day like this where you're running and you've got that and you stall, if I haven't sold proactively here, you can bet your ass I'm going to toss a chunk through the short term. That the 4M, I don't use it it just depends on something fast like this. I might, get rid of it. But, if I haven't been proactive selling it here after the, big run up, stall here, if volume's huge and we're breaking, and it really doesn't matter. It works anyway, but I'll tell you, I'm usually proactively selling on a day like this, especially if it stalls. And then if I haven't sold then and I start to see it break short-term moving averages after, I would call this a distributive action, I'm just going to back out of the way, because it can fall apart in a hurry.
For sure. So just to point it out for everybody, it has basically a climax move where it moves all the way to the high and then gives back probably 10-15% on that same day. So that's what you're talking about in terms of
this one, right? Yeah. So you break. So right here, you're buying at roughly 42. The high this day is what, roughly 58 bucks.
Yeah.
Right.
Yeah. So you're giving back 10%. Yeah. It looks like 58. Yeah.
Yeah. So 58. Just off the high there, back to 50. So. Yeah, so that's distributed. The volume is huge, right? So that is distributive action. I'm not going to say that that's necessarily a climax top. I'd want to go back and look at, but that's climaxy action, especially when you're talking about a stock almost tripling in a really short amount of time. And then when you're playing it for real and you've already got your average position on here, you need to be very, down in the 20s. You need to be very careful adding in the 40s, and if you do, you better be proactive selling some.
Yeah. I looked at the chart. It actually is the high so far, although it's getting a little bit tighter. It looks like it's forming a short-term base, and it actually made a really nice move. Why don't you bring it up?
I'll look with you.
Yeah, it made a nice move yesterday and hung in reasonably well today, honestly, given all the weakness.
So there you go, in real time. So that catches my eye. This is on my watch list. So when I go through my long watch list later, that would be an alert. So yeah, look at that. I mean, that is enormous volume at one point. So, and you given today, you pull back to, so yeah, this is one that you can, I'm not one to start quite yet. And given the weakness, especially given the weakness in the market. So I'll watch it as it comes in towards its 50. If volume starts to drop and it looks like, I might take a spot at its 50 with the 200-day sell stop just to see if I can scoop some. Now keep in mind, I'm not in a hurry to do that given the action that we saw today, but that's the kind of thing that I would look at. That's super significant. This appears to be under accumulation as it's working up the right side. However, you can see what happened to the earnings here. On the flip side, let's draw a big red line. There you go. 2021, we're looking for 51% pickup in earnings. So my guess is you'll start to see these quarterly numbers improve over the next quarter or two.
For sure. And Ross, so you say it looks like it's under accumulation. Can you point out the kind of things that tell you that? I think that'd be a cool thing.
So what I'm looking at, it's funny, big blue, small red.
Keep it simple. Keep it simple.
I mean, honestly, so, you know, you're working your way back up here through moving averages. Volume was pretty big. And so you can see as the stock works its way back in and shakes below its 50-day moving average here, you can see volume in general is below average as it sells off. And then what happens one day, I don't know, I'm going to guess there was news, you get a big gap up through its 50-day. You can see it stalls. Now, a lot of people here, this isn't really a stalling day to me. People, to me, what you need to do is take a blue line, it's going to be red, and start at the prior day's close and draw the rest of the stick in blue. Because really, that gap is strength. So it's not really closing at the lower end of the range. To me, goes all the way down to here. So not only are you holding the 50-day, you're still technically you're closing above 50% there. You're not. That is not stalling to me, although it looks that way with the gap. So you've got that, and then again, you see how you open you open in the wick of this bar, and I say the wick. It would be you know, we're not using candles here, but if we were, that would be the wick of the candle. When you see a stock open inside the wick, if it's a strong stock like that I was looking to buy or want to buy, sometimes I will buy it and then use the prior day's close as my sell stop.
That's gold right there.
Yeah. So yeah, that is one way that I'll do it too. So if I see a stock do that and leave a big wick, I'll even tell Ray, I'll tell Ray, we got some big wicks on, you know, whatever. So we'll watch the close from the prior day to maybe add or put on a position if we missed it altogether. So again, big blue, and we're pulling back. So it's a whippy stock. All you have to do is look back here. The ranges are wide. It is tightening up a bit, but I will say, you know, whatever the range was here from 31.55 to 35. I mean, that whipping around, and this is another thing I like to remind myself. It doesn't matter how right you are on a stock. If you buy it too big and for whatever reason you can't hold on until you're right, it doesn't really matter. And I've done a lot of that too. I've done that way. So that's why I'm always trying to get it to the point also to where, you know, buy it to where I can hold without wanting to pay. It's very easy to get shaken out. So this is you can see this is not a stock that respects its 50-day moving average. We don't have a 65 on here. But anyway, I'm not going to get too far. But so to me, again, you've got your big shake here on volume, but it ultimately tightens up and gets support at its 50-day. Again, you get the big push, and then volume tapers off again. Again, it looks like you're getting support on the 50-day, and here's one of those things you shake below. So I mean, there's nothing organized about this. So this isn't one that I'm just looking back in history. If you buy it on the 50-day, it looks like 9 times that, or at least half the time you're going to get shaken out. So there's no sense in doing that. There's no edge buying a stock on the 50-day. That's not holding it, you know, at all. However, I would buy it. So this is your 200-day. What I might, and again, depending on what the market looks like, the group looks like, I'm always looking at 2 major moving averages here. If these start to tighten up and it looks like we start to get some accumulative, if that's even a word, action here, it's nice and tight, and the 200-day isn't too far below, or I'm sorry, this is the 50, this is the 200. I might do that, you know, use the 200-day as an entry point and a 50 as to sell. And again, and a stock like this, because it's more volatile, the ranges are wider, you're tend to gonna be wrong more and lose more. Just
very cool.
The nature of the beast. However, now let me say this, because this breakout breaks out and it rips, and you break out and it has that quality. When this stock breaks out and gets going, it goes. So I won't hesitate, and it's liquid, trades, 2 million shares today is a big day for it. But it trades 700,000 shares a day, $36 stock. It's plenty liquid to put on a reasonable position. I got no problem buying this one on strength, just because you see I mean, there are times you can buy strength, and it doesn't work, but when it does work, it works big. So there are certain stocks I'll tend to shy away from buying strength. This one also, the breakout, you've got enough support right underneath it that you're still good buying strength there.
Yeah, and funds are buying it, increasing fund ownership. You've got one high quality fund in there as well.
Yeah, which is great from an IPO, little small cap fund. Earnings checklist isn't spectacular, but my guess is estimates are probably positive for the next several quarters, just based on, well, who knows? That's for 2000. Yeah, we're almost the end of 2021. We're looking for growth. We're almost at the end of 20 now. What, 3 months left? 4 months left.
Mm-hmm.
Back to our RH. So this one, we've got before we enlarge it, you've got your basic can slim earnings and sales here, in that 25 to 30% range. And if I'm not mistaken, I want to say that those numbers got bigger at some point, which I didn't understand for a while. But if I'm not mistaken now, Restoration Hardware did before I knew, they do hotel lobbies, that sort of thing now. That's like they've got that's a whole nother business besides just to design their houses. So here we go. This is another one where I'm gonna, obviously this volume is enormous here, so that definitely was an eye catcher. And then you immediately see here I'm not going to call this a flag, but it holds up in a relatively tight base or consolidation, I should say. We used to laugh. Bill O'Neill will tell you, set 6-week base, no such thing. So anything less than, so this is a little consolidation here, and you can see we're early entry. Look, this is a mess here. We've got a big gap down, met by a gap up. There's no solid uptrend here, but we are looking at specialty retail. Restoration Hardware is a little bit different, I guess, than your average furniture store. So you've got that going on for it. The earnings and sales were there. We start to see the volume coming in. So after we get a little consolidation here, my concern is, like we were discussing before, are we seeing accumulation? So we do have our 2 biggest days of selling are here. Both were below average volume. So bigger than we saw here, but it wasn't as if we saw a light volume rally and a sell-off. We saw volume taper after a big gap up. Volume came in, it shook down to its, and here I see. So what I have on here as well, I have another exponential moving average on here. It's the 17-day. This one, I don't know why I had it on there. It's one that I'll drop on there with the 21 and the 23 more often than not. It just adds clutter. So, so what we're looking at here is this light blue is the 21, this brownish maroon is the 23, and this gray right here is your 17. So anyway, you've got below average volume, and then again, volume starts to pick back up again as you move higher. So it's, again, that sort of thing. You're consolidating. I'm noticing overall, everything is fine. Your 5-day pocket pivot as it moves back up. You're holding up relatively tight above support. Volume's not that big. When volume does pick up, it's on the upside, and it accompanies positive price action along the way. So this early entry area, so far so good. You put some on. You might have see the volume. Typically, I would have added some here. It didn't do the volume, right? So we left it alone, and it doesn't really give you a whole lot here of volume. This drives me crazy. I can't tell you how many stocks float up on light volume, and then just the volume comes in at some point and it takes off, and I've missed something that I've been waiting for the volume on that just never gets there at the right spot, I should say. So this is another one where you're kind of waiting, but you're spending a lot of time really just watching it work. It's super easy just watching. It's 23, 21, 17, 21, 23. That's these that are all bunching up here. It respects it the whole way higher until you've got a nice consolidation again. That's more than just a week or two. So again, you can see drawing these lines. It's really simple. It's that stair step pattern. I'll go to a prior relevant high, draw a line across. You can see the moving averages again, catching the price and getting tight as the price, look at all of that nice tight action right above the moving average on below average volume. So when the volume starts coming back into it, again, it makes it very easy to buy. It's liquid, you've got the volume, and super easy tight stop losses if you're wrong. So so now this is finally, here is super early. All of this is, you would never see in a CAN-SLIM textbook. You're going to see that this is kind of something that I've started, something I observed, I do it, and so far it works. It's just a matter of when you're doing it, understanding that what you actually have some edge and that you're managing your risk along the way. I would tell you this: you can take any trade on the planet as long as you have edge and you have a plan to manage risk along the way. There's no wrong way to do it as long as you're managing risk along the way. To be quite honest with you, if you have edge, it doesn't matter if Bill likes to trade or Ross likes to trade or anyone likes to trade. As long as you have legitimate edge and you're managing your risk, it doesn't matter. That's that cut your losses. It comes down, how many people ultimately tell you that. I'll tell you this, my buddy Mike Webster, I still have his, I won't show it to you because he said I was never allowed to show it to anyone, but I have Mike Webster's rules from like 1999. Number one rule, cut losses, whatever it was, cut losses quick. Number two rule is, bottom line. C rule number one. I mean, that's honestly, you talk to anybody, is what it all comes down to is, not keeping your money, not letting it get away from you, living to fight another day so you can manage your risk for when it is working. Because if you can do it, if you follow the methodology, when it does work, you're easily going to make up for all of those losses and then some. I'm smart enough, Richard. I'm not, you know what I mean? I didn't go to Ivy League school. I graduated from University of Florida. I have a regular bachelor's degree. I've never had a debilitating drawdown. I'm smart enough to, if you study it and understand it and you follow it, it just works over time. Now, I'm not going to tell you, there are times where you can go for years and be demoralized. And it has nothing to do with the methodology. Not every market environment is going to be conducive to making money using CAN-SLIM, and that's why I always compare it to counting cards. Sometimes the deck's just not hot, and when it's not hot, you got to sit in cash. And sitting in cash for a couple of years is no fun.
For sure. So Ross, now that we've walked through charts and kind of seen how you look for accumulation and all of that, what kind of guidance would you give to a new trader who's just starting out and is trying to find a method?
There we go. So for me, Bill's methodology, I did the reading. I proved to myself it works, and it works with me, my personality, the way that I do things. Some folks, listen, there's a million ways to skin the cat. So the most important thing I would say is to find a methodology that's tried and true, that that works. And then from there, it becomes about taking that methodology and really getting it down, going back, studying old trades and creating rules to make a methodology your own. Because until you really get it into you, go back, look at the charts, understand it, look at your mistakes, create rules that are fitting to your personality, your risk profile. And I would say this, and this is what I drew a blank on earlier, that Bill used to say: learn one thing well, and that's it. Bill I never saw him do any shorting. If he did any, he did very little, if any. People like to say that, oh, you're a long only guy. Well, really? Is that a bad thing? Is Bill the billionaire the long only guy? Is there something wrong with him? Well, listen, as long as I can be a billionaire being long only, that's fine. So, and I say that joking around. Bill, I have, shorting is fine. There's guys who are really good at it. I've got a buddy who's a prop trader who can short all day long in a crazy bull market, and he's good at that mean reversion thing. It's not, but learn one thing and learn it well. And I say that because, like we discussed before, you can go for a very long time where a methodology that is tried and true doesn't work, And it just doesn't, because sometimes the market isn't cooperative with your methodology. And that's just life, very similar to counting cards. The deck just isn't always rich. There's not always, face cards in there waiting for you. So and that's honestly, so don't go jumping around trying to change your methodology. Do the best to learn one thing and stick to it. I've tried all of that, and sticking to one thing and knowing it well. So making sure that it works, really making it your own, and don't go jumping all over the place. And I think if you spend a good 2 or 3 years, and obviously market environment's is gonna make a difference there. If you tried, learning Bill O'Neill's methodology at the beginning of 2000 or 2008, when the market just was not especially conducive to that methodology, you're going to have a horrible experience with it. So, timing is everything, obviously, but, those would be that would be it. Find something that works, stick to it, make it your own. And, number one rule, lose your ego and get used to being wrong and cutting losses. I know a lot of people that have made money in the easy market. I know very few people that have managed to keep that money.
Perfect. So, Ross, thank you so much for your wisdom. I appreciate you taking the time out of your day to share what you've learned, and especially going through the charts. I really got out a lot of it. I'm sure other people will too. Thank you guys so much for watching. If you enjoyed, please remember to leave a like down below and comment if you have any questions or something you'd like to ask Ross here. Ross, thanks again. And I'll see you guys in future videos. Yep. Thanks, Ross.